Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. I am your host, Ed Lopez, and today my guest is Brian Colello, technology equity strategist at Morningstar. I've been looking forward to this discussion all about semiconductors. We hopefully will talk about the current state and future of the semiconductor industry. It's been a hot topic this year, and I am thankful to have him on the show. Brian, thanks for joining.
Ed, thanks for having me. I'm excited to have the conversation too. Appreciate it.
We are just the first few days after quarter end. We're in early October. I got to imagine you're getting ready for earnings season and prepping for that.
Exactly. Digesting the news, trying to anticipate what we're going to hear, trying to capture as many signals as we can from, the various end markets, and covering names like Nvidia and Intel these days. It's a fire hose of information. We're trying to pick out the signal from the noise. It's been a hot topic for years now.
Are you using AI to help you keep up with any of that?
A little bit, to be perfectly honest. Yeah, it's just as Google, Google search can help us, identify a piece of jargon or to understand a technology. We're using ChatGPT the same sort of way. For compliance reasons, we're definitely not using it to, determine what we think a stock is worth or doing anything to front run numbers. But probably the best dictionary out there and the best textbook out there. So it does help us at times.
I was just kind of curious, how important are earnings calls to you? I mean, you get the financials and all that, but are you listening for something in particular in earnings calls? Do you participate in those?
It's a great question. There are many times where they're not all that important, particularly because at Morningstar, we take a long-term view. So we think about how things are going. So sometimes it's steady as she goes. And sometimes, I would say maybe 20% of the time, it's really meaningful. 50 to 60% of the time, it's like just making sure things are steady. And then, maybe 20% of the time, it's a non-issue. But, I think we sort of treat it all the same, and we definitely want to be ready for all of it.
And those big changes, or if something's really changed, I mean, are you listening to the tone of the speakers and whether or not they feel confident, things like that, or just kind of what they say?
I think that matters. Absolutely. You do lose something if you just read a transcript versus if you actually hear, the management team speaking and, that tone of voice. I think I've read, what is it? It's like 7% of what someone picks up is the words themselves. And, 93% is the body language and the tone and things like that. And so that matters. So we do try to listen and pick up on those nuances to assess confidence when people are making a statement about the future or what they're seeing. It does matter.
Well, that's awesome. So, like I said, I've been looking forward to having this conversation. I guess one thing I didn't realize really until this year are the differentiated business lines or business models within semiconductors. And maybe for the purposes of creating a level playing ground or starting ground here for our discussion, I wonder if you could kind of just broadly describe some of the different business models within the semiconductor space, companies like Nvidia or TSMC, and I don't know, just kind of quickly at a high level, kind of explain that.
Yeah, gladly. And, it is interesting because we actually, at Morningstar in our equity research department, we publish this big semiconductor, what we call an industry landscape report, where it's just basically the map of the industry and the supply chain. And we debated internally, well, which segments of semis do we include or not include? And there are pieces that fall under semiconductors that are very different businesses and very different business models. And, should we write 3 deep dives into this, or do you put it all in one, even though these things are very different? So it is a complex supply chain, and business models are very different. I think I could start with chip designers, which are often called fabless companies. And so that would be like Nvidia, Qualcomm, AMD, Apple. They focus on the design of chips. Then there are the foundries, which focus on the manufacturing of the chips. Again, because we're talking about nanometers, which is something like 50,000 nanometers fit inside a human hair. So that's like the miniaturization of what we're doing in semiconductors. So that's obviously very complex on the other side. So the foundries focus on manufacturing, the fabless focus on the design to get the chip to do what they want it to do. And then you have IDMs, or integrated device manufacturers, that actually do both in-house. And Intel has been the shining example of this for 30 years. And I'm sure we'll talk about it is not necessarily a shining example anymore. And it might be the last sort of digital IDM left standing. And we're probably on the precipice of that IDM model breaking up. You'll see some IDMs for maybe more mature technologies like an analog and mixed signal. They don't use cutting edge chips, so the manufacturing isn't as capital intensive or R&D intensive. So like Texas Instruments, Analog Devices, Infineon, ST Micro, those are still IDMs, as like they will design chips and manufacture them in-house. But you often see that manufacturing on older equipment, legacy technologies. So, what's leading edge for a Texas Instruments is very much trailing edge for somebody like an Intel or Taiwan Semi. So that sort of sits there. That whole ecosystem, I think, really started maybe in the 70s or 80s with the emergence of Taiwan Semi, of just raking up the value chain. That it was very capital intensive for any startup in the semiconductor industry to not only design a chip, but to build out its own fab and become experts in manufacturing. Taiwan Semi said, well, we can focus on manufacturing for our customers. We won't compete with them. And so we'll be an outsourced manufacturer. And over the past several decades, we've seen more and more business shift that way. And because Taiwan Semi has emerged as the highest quality leading edge chip maker, you see more and more design and more outsourcing to Taiwan Semi, to the point that even Intel's latest chips use Taiwan Semi as well, rather than it's in-house. So I think we're definitely a place where chip design and foundries will be probably 100% split in the future, at least for digital semis, at least for processors.
And do these different business models have different profit margin kind of on average that you would look at and benchmark against?
Yeah, absolutely. And that's important. So, the struggle with the IDM model is that semiconductor manufacturing is an extremely high fixed cost business. If you were trying to build a leading edge fab today, we're probably talking $20 or $30 billion. And that's high fixed costs. And that is independent of how much revenue the business earns. So, in the Intel case, in the Wintel days, that made all the sense in the world when they had 95% market share of the PC market, because that wasn't $30 billion to build those fabs, let's say 20 or 30 years ago. But whatever fabs it built, it filled those fabs with demand because it had a basic monopoly on the PC business. So if you have enough revenue to cover your high fixed costs, you could be very profitable. And that was the Intel model for a lot of years. If you look at the foundry model today, that is, let's call it a cost plus sort of model, just to be sort of simple there. Again, Taiwan Semi has the high fixed costs, but if they get the orders from Apple and Nvidia and AMD, and they can fill those fabs and be profitable as well. And whatever they produce, it's cost plus, and the fabless companies will pay it because they don't have any other alternative. Taiwan Semi is the best outsourced manufacturer today. And it's up to Taiwan Semi to make sure they don't over expand. And so they're always talking about they're getting demand signals from their customers. And so if we start talking about Nvidia's valuation and how do you get comfortable that this is still going to be a multi-trillion-dollar business, well, you could look at Taiwan Semi and see that they're investing in new fabs and new packaging capacity to get ready for this explosion of demand coming from Nvidia. That's still on the way, apparently. So I think that's where you get to see that Taiwan Semi wouldn't be spending these billions to get ready for Nvidia if they didn't think it was coming through. So that's usually a pretty good demand signal for us. Same with Apple with an iPhone launch and things like that. And then on the fabless side, the selling a chip like from a Qualcomm, Apple uses it in-house, but Qualcomm, AMD, Nvidia, that, it's now a variable cost business rather than a fixed cost business on the gross margin side. So that leads to sort of less variability on sort of gross margin and less cyclicality on at least the top line, or at least on the gross margin line with earnings, but you still have a high R&D base to sort of sell to. So those stocks are still certainly cyclical, but not to the same extent as an Intel, for example. Like Intel peak to trough right now, that was a business earning 65% gross margins. It's going down to 35, right? Because they just don't have enough revenue to cover all these fixed costs. You're not seeing that sort of downfall at a company like a Qualcomm or an AMD because it's more variable.
So one of the other things that we've noted before, and I find interesting because I don't know if this exists in other industries, you guys do these wide moat ratings for the stocks that you cover, and looking at an index of large semiconductors listed in the U.S., we're still kind of stunned to find that I think 13 out of 25 of those names have wide moats. Do you have a thought about how you can have so many wide moats within the same industry? Are they all doing something just a little bit different and dominant in that particular space or niche of theirs?
Yeah, the short answer to that is yes, for the most part. Although there are some examples where companies are doing the exact same thing. So, if I could just take a step back, our moat methodology is at Morningstar. We spend a lot of time thinking about the durable competitive advantage of a business. So economic moats, that's a term coined by Warren Buffett about just as a water moat would protect a castle in the Middle Ages, an economic moat would protect a business and allow it to generate excess returns on capital or very healthy returns for a longer period of time than if a company didn't have a moat. So we spend a lot of time thinking about the strength of that moat. Is something our clients think about too, and it really ties into sort of the long-term perspective we have when we think about companies. So, and we offer 3 ratings. So none is most companies are none. Even if they seem to have an advantage today, we're not sure they will, let's say 10 years from now. Then our second rating is narrow, and that's a company where we think more likely than not for the next decade, they'll generate excess returns, but it's probably hard 10 years from now to sort of guarantee that. And then that leaves the wide moat names. I think there's about 160 in the US that's even part of our sample size. So these are the best of the best businesses. So that's like the Johnson & Johnsons of the world and the Procter & Gamble's, Costco, Walmart, Amazon, Microsoft, Google. But we do have a lot in semis in a couple different areas, and they are different. So Taiwan Semi is not US domiciled, but also has a wide moat across our Asian equity research coverage. I mean, again, they are dominant in foundry, and this is extremely technologically complex. It would take decades to try to even come close to doing what Taiwan Semi does. I mean, there are many other digital foundries out there that have foundry expertise, and none of them have been able to touch it. And Taiwan Semi has that cost advantage where they have the best customers today, so they get the best pricing, so they can plow it back into R&D, which allows them to be on the leading edge again. And it's a really great cycle if you can continue it. Where it gets interesting with the Intel perspective, which was a downgrade from wide to none, is when that manufacturing breaks, whether it basically misexecution and strategic missteps, and now you're at a cost disadvantage, and now you can't catch up. So chip equipment, we see a lot of wide moats as well. ASML is just, their EUV machines are just so technologically complex. Like they're nearly impossible to match. This is a big problem for China because of the U.S. restrictions on some of the ASML equipment. So this is why the U.S. government, and what we would think is that the restrictions are going to prevent China from keeping up with U.S. chip makers in artificial intelligence and other areas, unless China comes up with some sort of exceptional breakthrough. I think all these moats are competitive advantage. None of them's impenetrable, but you have to have a breakthrough. You have to get lucky to sort of circumvent some of these things. And then unless China does that, the U.S. restrictions are going to keep them behind because ASML is so dominant. The other chip equipment is still extremely complex when you think about etching and deposition. And again, the miniaturization of using gases to carve out transistors 2 nanometers, 3 nanometers wide on a semiconductor, really difficult equipment. And they benefit from servicing as well. So it's one thing to buy a $50 million piece of equipment to install, but if it breaks, who's going to run it? And so that's where the chip equipment companies are all able to, many of them are able to carve out wide moats as well. So Applied Materials, KLA. In analog and mixed signal, we see wide moats as well. Again, that's the trailing edge item. So Texas Instruments, Analog Devices, Microchip, NXP. Those companies have many, many products that compete with one another, but there are truly millions of chip opportunities per year. And so that's a fragmented industry with a diverse customer base. So all those companies have tens of thousands, if not 100,000 plus customers that they're selling into. The redesign costs are too onerous. So if you're designing an electric toothbrush and you use an NXP microcontroller, as long as you're rebuilding that toothbrush, you're going to keep using that microcontroller. Analog Devices has this great chart. They are still selling products they designed in the 1970s that are still being put in use today, because why switch? These are 25, 50 cent, maybe $1 parts at most. And there's a lot of redesign and retesting. If you were going to switch to somebody else to save 20 cents on a product, like it rarely makes sense. So once you're designed in for the life of the product. That matters more when we get into like the car market or industrial, like heavy equipment. So same thing, you're buying like a $1 microcontroller for a $50,000 car. That's not an area where you're going to try to save a nickel and buy from some upstart. So the analog companies have wide moats. Nvidia is a unique animal because they dominate in AI. So it's not just the hardware advantage they have in GPUs, but also the software. I mean, they basically created the ability for people to build large language models, and all of the training is done on Nvidia GPUs. So that's a unique case in semis. where it's not just a chip manufacturing or chip design expertise that leads to the wide moat, but the software angle as well. So yeah, there are different sub segments of semis that benefit from wide moat. So some within each pocket, some of the companies, yes, they do the same thing and compete with one another. But I guess another way to think about it is the startup world. Like, can a startup come in to do what these companies are doing? And in most cases, the answer is like not even close. Like a startup to try to compete with Texas Instruments, sure, you could come up with 5, 10, 100 products that compete with what TI do. You're not going to come up with 10,000 like what they have. You're not going to find the 100,000 customers that TI has. You're not going to have to spend the hundreds of millions to sell 40-cent parts to try to displace them because you sell them for 30 cents, and those customers aren't going to redesign their toothbrushes and their webcams and their cars just to get that, slightly cheaper chip. So yeah, they all benefit from wide moats and have good profitability. Semiconductor manufacturing and design is extremely hard. Again, if you look at the blocks on some of these chips and how intricate they all are, it's not something I could do, or me and you can't start a business and get into that tomorrow. It's really complex.
Yeah, it's super fascinating and exciting to think about the concentration of companies with a diversity of business lines that you can get with, by looking at the semiconductor industry. And yeah, I guess the number of dominant players there, which I think is really pretty cool. The complement question to that is like valuations, generally roughly, I don't know, do you have a sense of, are valuations stretched generally, or is that more kind of a one by one basis?
Yeah, I would say it depends on the subsegment. So in general, chips are fairly valued, but we do see a difference. So the digital names, the AI names, they don't look all that cheap to us today. Not to say that we're necessarily accurate. I mean, when we think about our fair value estimates, or at least when I do, I think of it as a range of values. So when I think of Nvidia, I'm at a 105 fair value estimate. And that is, I think that balances the risk reward of, yes, they're absolutely dominant in AI, and there's going to be more spending on AI, certainly this year, certainly 2025, and it will grow nicely in the future. So I'm not bearish on the AI opportunity anyway. But if you're buying Nvidia at 120, 130, 140, you have to be even more bullish, right? They have to fend off all of these new upstarts. The spending at Microsoft and Amazon and Google has to continue for several more years. We model Nvidia, growing revenue 40% next year. We have a 20-something percent CAGR the 3 years after that. If Nvidia only grows 10% a year anytime in the next 3 or 4 years, that's going to be disastrous for the stock. So, and again, if you're buying at 140, this is a business that's going to have to grow probably 30 or 40% for several more years, which means the cloud companies, the Microsofts and Meta, are going to have to spend at that pace for several more years. They're all saying that 2025, they're going to spend on AI, but are they going to spend even more in 2026 and 2027? So that's part of the debate. What does market share look like? Or sure, they want to spend and they want to build out their AI capabilities, but they're going to get more efficient. And so maybe they're using their own in-house chips or turning to startups. There's a lot of potential risks along the way, I guess. At 105, I think there's a nice risk. That's where we see a reasonable risk reward on Nvidia's. But, if it trades higher than that, again, I don't think there is the entire ride I've ever told anybody to sell in Nvidia per se based on valuation. But at certain times, if you're buying, it has to go right. And now for the past 15, 18 months, everything has gone right. So, a lot of people have made a lot of money by buying Nvidia because things have gone right at a way that has just been sort of historic and probably unprecedented, I would say. I mean, I guess the only comp is Cisco in the 90s, but they were a startup. So this is just absolutely historic, once in a generation sort of rise at Nvidia. So that's where, we think some valuations are stretched. We think we're stretched at names like Broadcom, for example. Intel is a name, even after its fall, we're at a $21 fair value now. So we cut it significantly after their brutal earnings report. So that's not a cheap stock. That's not one, we're particularly fond of, right now either. The names we think are cheap are in the power semiconductor space. So names like STMicro, Infineon, on Semi, my colleague Will Kerwin covers that one. And then also NXP, not as cheap, but US-based wide moat. And actually NXP is in the wide moat focus index of ours as well. All of them are exposed to the automotive market, and we are in a bit of an inventory correction in auto. You had this big global shortage for 3 years, so they're buying as many chips as they could. And now the auto market is sort of correcting their inventory levels and adjusting for that. So that's one issue. I think the other issue is EV sales, while still growing, are not coming in as high as previously expected. And anytime cycles will happen in semis, anytime actual demand falls short of forecasted demand, because customers basically buy too much. So they pause their orders the next go around or the next time they have to place orders. So, I think that's what we're seeing in semis, but the long-term trends are still there, that we're going to see more electric vehicles. Electric vehicles use more chips per car. These companies aren't necessarily losing share to competitors. There's some risk at ST Micro and Infineon that, like, on the power semis, that like China is investing in trying to build chips that will compete with ST and Infineon in particular in power semiconductors, which sort of deliver voltage. That is a medium to long-term risk. And I do think it eats at those companies a little bit. I think the market's pricing those names as if China is going to destroy those businesses. And we don't think that's the case. So I think that's an opportunity there. But again, for the wide moat focus index, NXP, we just had the reconstitution. NXP is in there. It's one of the cheapest wide moat names. And that's a name I feel pretty good about. I think they'll rebound nicely as the car market rebounds, as the auto supply chain sort of corrects its inventory.
I think you mentioned earlier Nvidia having a dominant position for several years, but is there somebody who's their nearest competitor in the AI space that you would be watching?
Oh, good question. The short answer is everybody. And it because this is a hundreds of billion dollars opportunity, capitalism works. You would expect everybody to be sort of competing here. So, Nvidia is everybody's partner today. So on the one hand, all the cloud companies, they need Nvidia desperately to roll out AI and to run these models. And at the other hand, they're going to do everything they can to reduce their reliance on Nvidia. So that's the give and the take that I'm thinking about when I think about Nvidia's valuation. I suppose the biggest competitor right now is AMD. I mean, it always has been in GPUs, which are graphic processors. It has been for decades. So in gaming GPUs, it's Nvidia versus AMD. And now in AI, we're seeing the same space. So part of it is like the nature of the GPU is best suited for a large language model. So the two best companies to serve AI are the GPU makers from gaming, whether it's Nvidia and AMD. You're basically taking similar sort of chips and similar architectures, and you're applying it to a new end market. Now, Nvidia got there first and earliest and was more invested in it than AMD was, let's say 10 years ago. But AMD is catching up. They're catching up on hardware and software and everything else. But at the same time, all these models have been built on Nvidia. So even if AMD is catching up, nobody's trying to move off of Nvidia to test an untested sort of company like AMD. Like, nobody's waiting for AMD to sort of catch up. And, I guess the old saying, like, nobody gets fired for buying IBM. Like, if I'm a startup large language model maker, I'd probably get fired if I take a chance on AMD rather than use the proven Nvidia chips and Nvidia ecosystem today. So the current models are built on Nvidia. You would think startups would use Nvidia. But that said, AMD is going to have its place. So the large companies like Microsoft and Meta and Oracle and others, they're testing out AMD. They want choice and competition. So they're going to support AMD and use it for certain workloads. Actually, some of these the new OpenAI model, what's called the Strawberry model that just came out, the O1, that's actually interesting because that uses a lot more sort of inference chips. So that might give AMD more of an opportunity because, like, if you're using much more inference and AMD might be more cost effective, if you just throw more AMD GPUs at the problem, you might get a better outcome. So that could be the one avenue where AMD sort of carves out a piece of this market. I don't think they're going to take over the entire market. I think the AI training business is over and Nvidia dominates that. So I think Nvidia is still going to be the dominant AI player, but AMD is going to carve out a piece. And then you have the in-house chips from Microsoft, Meta, Google, Amazon. Again, if these companies can save, literally billions of dollars by not buying Nvidia and using their own chips, even if it's for certain specific workloads and they're not flexible and they just do this one thing really well, that's a material cost saving for these companies. So that's going to happen as well. And that will eat away at demand for Nvidia's chips. So I think Nvidia loses market share over the next few years, but on a much faster growing pie, so that revenue still grows really nicely. But AMD is going to get its share, these in-house chips, and some startups are interesting. Cerebras just filed for an IPO. They've been a name we've sort of been keeping an eye on, at least for AI inference. Grok is another one. So there might be a couple startups that come in as well. But I guess you still have to say AMD is the biggest competitor, but really NVIDIA's dominance is because right now today there is no competitor. NVIDIA's added $3 trillion of value. So it's not like they're doing it in a fragmented place. They're doing it because they're in the right place in the right time for this massive market. And for quite a while, they're the only game in town.
What would you be looking to determine or to see any potential headwinds or obstacles in the future? Would you be looking at CapEx spending across different industries in this area, or something else? Or I don't know. Are there factors that you kind of keep top of mind in terms of seeing, okay, maybe things are going to really start to slow down?
Yeah, it does come down to end markets. And even, when we talk about moats, I mean, so the chip manufacturing design is one piece, but there's the end market demand, which is the other. So like, as a semiconductor analyst, I'm not even necessarily focused on which chip comes out. I'm focused on the health of the PC market, or the smartphone market, or the AI market. AI, I think, very much comes down to the spending of the cloud companies. And now that's not where Nvidia sells all of its business, but we think they're representative of everyone else. I find it hard to believe that if the cloud companies stop spending, that the enterprises will spend more, or consumer companies will spend more. So, we've heard positive language from Microsoft and Meta and other that they're going to increase their AI spending in 2025. So that's something we'll keep an eye on. If any of those companies hint at a slowdown in AI spending, you will see it in Nvidia stock that evening and the next day. I think it was the Google CEO that came out. They confessed that we would rather overinvest in AI than underinvest. And so that stokes concerns that this is all, let's call it an AI bubble. I don't necessarily think we can talk about the nuances of a bubble. I don't think we're in a bubble today, but like just the fact that, if they say you're overinvesting rather than underinvesting, well, that means that at some point you have to correct, so that at some point there'll be a pause. I don't think there's an AI bubble. Certainly, I'll say this on the bubble part, I guess. Right now, demand exceeds supply, and all these GPUs are putting to use. So when we talk about the internet bubble, that was very much like we're laying dark fiber in anticipation of all this internet demand is going to come. And then we put out way too much. And so that was like a massive bubble. Right now, the GPUs that are being deployed, that are being sold, they're being put to use right away. There are not shelves of empty, unused GPUs today. It wouldn't even make sense to do that because these GPUs will be antiquated in, 3 to 5 years. So it's not, dark fiber might last decades. These GPUs don't. It doesn't make sense for anybody to hoard these GPUs and not use them. So they're being used. For this to be a bubble, you have to say like all these customers that are developing AI today, stop developing AI. Like the sort of the end market demand, or the end customers, the software developers, they all need to pull back. That will cause the cloud customers to pull back. And then that's where we sort of see a bubble. But it could be a bubble, it could be a cycle, but it's not because it's a mirage today. And I think that's sort of a nuance, whereas like some bubbles are because of a mirage. It's something that's expected and it doesn't really come to play. The AI demand is very real today. Now, if you tell me, we all stop and, it's like a party and they turn the lights on and everybody scatters. Yeah, that's a bubble, but that's pretty much everything. So that's sort of the AI market. The other markets we're looking at, like automotive's another one. Anytime we see a big earnings warning, we get a little concerned about units. Now, again, auto can be a content story. You could have flattish car sales, but it could still be good for automotive chip makers because content per car goes up. That's the give and take there. But again, like if car sales fall through the floor, that's obviously not good for automotive chip makers. That's something we're thinking about. The iPhone 16 rollout is another one because we have companies like Qualcomm and Skyworks and others. Apple is such a big buyer of semis that if they fall, there would be pain for others. So, the iPhone is interesting for us. PCs, same way. We're always sort of looking at PC units. But again, there's inventory and that sort of smooths out. And, PCs at this point is sort of a flattish market. So it's meaningful if PCs are down 20%. That would be a surprise. But, that's sort of a flattish market. We're not expecting massive growth. And we were to somehow get massive growth this quarter or, in any given quarter, that's a cycle. That seems like a peak to us, and that would probably revert to the mean a bit too. So I think those are the things we're looking at as semiconductor investors and analysts is the health of the end markets. And, but to your point, AI, cloud CapEx is the one. We get that question a lot. Like if things start to go wrong, what's the signal? And that is very much the signal. So look at Google's earnings, look at Amazon. To be honest, I don't know if you get good signals prior to that. I don't know if I would trust any tweet or analyst maybe if there was a flood of chatter that, someone would had overcapacity, I suppose. But the spending patterns of those big cloud companies is so opaque that, it just takes a few big customers one way or the other to determine the fate of Nvidia. And so I think that's really the best signal.
And you mentioned some other industries. You mentioned EVs and auto. Are there other technologies, emerging technologies that people should be watching? I don't know what we call it, quantum or edge computing.
Yeah, good question. I mean, there are always new technologies, and part of this spending in AI right now is so the AI semis are being used, and the demand is there. But for any new technology, the semis have to come first. So they're often developing and spending in new technologies, and like the emergence sort of comes later. So the bearish case on Nvidia over the past few months is, okay, there's all this spending. Where are the companies generating the revenue to justify all this spending? And right now, that's a good question, but that's always just been the nature of semis, that you have to put this in place. So all this development is happening. Yeah, you do have, again, part of that like AI bubble conversation, like all these companies are investing in AI. Are they going to generate revenue from it? We think some of them will. We think many of them will insert AI in their products and allows them to keep their business and not be destroyed. There's going to be R&D spending. And so like, I think the spending is sustainable, but there's always, that sort of question there. Chip equipment, there's always new technology. So ASML has these new high NA EUV machines that will be used in leading edge manufacturing. So there's technologies there. Quantum computing isn't really hitting our radar. That it's not in direct competition with a lot of the chip makers that we have today. I mean, it's something we're keeping an eye out on, but it's still a pretty immature technology from our point of view. So it doesn't really threaten our moats or competitive advantage or impact revenues of the companies we cover in any way. In EVs, one of the big trends is towards silicon carbide power semiconductors. So Tesla started this with its EV, but then it has an inverter inside the electric vehicle to sort of manage the voltage. If you use silicon carbide in there, you get a smaller inverter. It handles the heat better. And if you have a lighter, smaller footprint, you can get more range out of your battery. Silicon carbide is a material. It's not even really found on Earth. It's crystals that have to be grown and manufactured. So it's a complex process. You've seen a lot of investment there. Now China's going to come in on that too. So that probably gets commoditized over the years, but like companies like ST Micro and Infineon, that's been a big advancement there. So we're keeping an eye on that. I think in AI, I mean, again, we talked about Nvidia, that's all sort of data center AI, but you'll hear Qualcomm, Apple, others talk about on-device and edge AI. We haven't seen tremendous demand for that yet. Like, Intel and Qualcomm talked about the AI PC, but it doesn't really seem to be making a dent in PC sales yet. We could be wrong. And that'll be something we'll be trying to listen for this earnings season. But I don't think the AI PC is taking the world by storm. I mean, again, the biggest large language model, this thing about ChatGPT, that is a cloud-based model. That model isn't going to sit on your device and, you're not going to be able to run it, if you're out in the woods somewhere. So I guess finally, like, it's the new technologies so it's not even necessarily the chip technologies, but what the end market technologies are. So Meta with the Orion glasses and Apple with Vision Pro, like obviously there's tons of chip content in there. So those get really interesting. Like, if you just think about like the average consumer, like, okay, I had a PC, now I have a PC and a phone. Now I have a smartphone that has much more chip content, but now I'm buying tablets and AirPods. And now if you tell me I'm buying, VR glasses with hundreds of dollars of chip content in there, that's a big positive. So I think those are the technologies we equally look out for in addition to like the chip advancements.
Let me get your take with the last few minutes that we have here, last few words, if you will, on the semiconductor industry and outlook. I mean, what do you see playing out over the next year to 2 years in the semiconductor space?
Yeah, gladly. I mean, AI is the probably most important market. And so I think that one, Nvidia, I think their revenue is locked in for the rest of 2024 and probably most of 2025 as well. They've talked about demand still exceeds supply and they're going to have problems keeping up with demand. So I think they're going to grow revenue by a few billion per quarter by quarter, as more supply comes online. So I think AI is pretty locked in. The industrial end market, and that could be medical equipment, that could be like factory automation, appliances. That's where military and defense goes into. We just had a big down cycle there. It's starting to recover. That one is going to really be tied to the health of the macro environment in the economy. So if we have a U.S. recession or, China has a severe recession, that bounce back won't be as sharp. So that's something we're sort of keeping an eye on near term. But again, you're seeing more chips in all of these sort of devices. Like there's just more chips, more processing power, more sensors, more connectivity. I don't know, your smart toothbrush, your smart dishwasher, like there's just more chips and things that didn't necessarily have them before. So that's still a positive trend. Autos we talked about, there's a recovery coming there, we think. And again, there's still more chips per car. Every new feature you see in a car commercial, like that's driven by semiconductors. And so, the long-term trends are still there. PCs, I still think it's sort of like a flattish market, although I don't know if there's some sort of buzz for the AI PC, you might get a near-term bump there. smartphones, we're still looking at Apple, and I don't think that it's not looking like the iPhone 16 is going to be this super cycle. I think Apple investors have been looking for that, and they're like, oh, AI is just going to drive this huge upgrade cycle. But AI is coming, their Apple Intelligence, they're sort of in-house, like that seems to be rolling out a bit late. So I don't think this is the year we're getting that super cycle. But if that does happen, that might be the iPhone 17, for example. And if that happens, then that would be a positive for the chip supply chain. So, the larger trends are still there, more chip content, and then AI is sort of just this big wild card. But I think the spending is going to be there.
Outside of semiconductors, is there a technology or a theme that you're particularly excited about or investment area?
I always poke around. At software. I think software is just such an interesting space. I mean, I guess I'm still talking the technology book, but I mean, the SaaS business model is so interesting. So I'm always looking at companies that can sort of gain scale and gain a critical mass of customers because like it's so sticky. Now you hear some buzz that sort of AI might replace the software industry somehow. Like, oh, I could just spin up software of my own, or like if I just have data like unstructured, just sitting in a data lake somehow, if I could just use AI to pull it out, then why am I buying this fancy interface of software? I suppose that's possible, but I also tend to think that that's sort of decades away. So I'm always sort of poking around personally at like sort of, smaller software names at good growth rates that, might not be priced for their future growth. So I think that's something I'm looking at. Otherwise, I think I'm lucky because I think AI is the trend in technology. And so I guess by covering Nvidia, I have to be looking at it for my day job. I guess if it wasn't my day job, I'd probably still be looking at it anyway.
Awesome. All right, let's do a quick round of trend or fad. I'll ask you about 3 or 5 different topics. You can give me your quick take, trend or fad. The metaverse, trend or fad?
Ooh, there are definitely people in my office that say fad. I would say trend. I think we're just seeing more digital, more virtualization, avatars, like digital content, digital lives. Like I think it's going to happen. I think it's slower than what anybody's expecting. I don't expect anything anytime soon. It might not even be a thing. It'll probably be blended with AI and whatever else. But I think, 20 or 30 years from now, like I think we'll look back and say, oh yeah, this is, if you call it metaverse, fine. We might be calling it something else, but I think we're all going to probably have more digital lives than what we have today. And so, yeah, I say trend, but I think I'm in the minority on that.
Nuclear power, trend or fad?
Oh, that's a trend. And we're seeing that in AI right now. Microsoft, Amazon struck deals. Like that's been a surprising question all year is like, how are we going to power these things? And yeah, I think that's been eye-opening to me. And for our utilities team, I mean, they barely see growth. And so for them to be talking about, very high growth business, I know it's a sliver of the utilities industry or whatever else, but that sliver is going to triple. Like that matters for utilities. So no, I think that is a trend towards, towards nuclear, particularly for use in AI. We'll see if the government, again, restrict that or in any way, but absent that, no, that's a trend.
Printable electronics, say for wearables, trend or fad?
I'll say fad on that one. I mean, I think 3D printing has its place, but I tend to think of that as like more like machinery, custom parts, stuff like that. I mean, I think wearables is a trend. I don't think they need to be printed themselves. I think you'll see plenty of companies still doing it. So I'm a person I'm an Apple Watch wearer. I have Whoop, which kind of competes with the Oura Ring. And so like, I never thought about like needing to wear like a ring tracker, but like, okay, I guess I have real estate on my body. Like you could put something more digital here, or, there's probably room on my body for a necklace, or even like these, the Meta Orion glasses, they talk about having a puck, like, to sort of offload that, like, all right, so I guess there's a place for digital content on my head and on my ring. And I guess now maybe I have to hold a second device to do the offloading, but maybe not. So like, yeah, I guess there's more places on our body for stuff. But so I think wearables is definitely a trend, but printable, no, I think that's a fad.
Fed funds rate cuts, trend or fad?
I'm not necessarily a Fed watcher on this. The semiconductor companies sort of hinted at, industrial not bouncing back the way they thought. So I guess I'll say it's a fad. Yeah, I'm not really the right person. I mean, I think you're going to get a bouncing back and forth for a while. Like this is the new normal. It's not going to be 0% again, like what we saw in sort of 2021. But whether it's cut 50 now and raised by 50, I think there'll probably be a bounce back in inflation and maybe raising again. And so I'd like to think maybe we're in a more normal environment. Like there's all the discussion of the soft and hard landing, and to me, I guess this is like the airplane first touching the ground. So like it's going to touch the ground again. and again and again. And so like, we'll see what those bumps are like. I guess fortunately for me in an AI world, like I think that spending happens either way. So it's not necessarily top of mind. The environment's good. I think companies are going to invest in AI. If the environment is bad, then companies are going to try to be more efficient. And that means rolling out AI even faster. So I think the spending's there either way. So again, like I'm not the best person as a Fed watcher, but I guess in my world in Nvidia, like I would argue that it matters less to me than certainly a lot of other industries.
Fantastic. Brian, this was awesome. I could keep asking you and pinging you with questions, but I'll let you on with your day. Thanks for joining and your time today. What's the best way for people to follow you or learn more about your research or Morningstar?
Sure. So Morningstar.com is our retail website. So you can just anybody can subscribe there. We certainly work with financial advisors, so they have access to all of our content as well. We have an institutional sales team. We have our, the Morningstar Wide Moat Focus Index, which we partner with Van Eck. And so that's a terrific product. So I would say, for any interest in what we do in determining, cheap wide moat companies, or I would turn that back to you and your team to sort of, to be a good contact. Personally, I'm on LinkedIn. I don't do much, Twitter or social media just because of the compliance aspect. I need to get, my thoughts out the door to, our clients and can't, really front run anything. So, I don't have as much of a voice as, I probably could in a non-analyst world, but so I guess I would turn it towards, the official channels at Morningstar, but, I think Morningstar.com is the first place to start.
Check that website out, and anybody that have questions about products that we offer with Morningstar, you can always check out vanek.com. And again, Brian, thank you very much for your time.
Ed, it was a pleasure. Thank you.
And thank you for tuning in to this episode of Trends with Benefits.